Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Axon Tire would like to give the loyal listeners of the Moving Iron Podcast a free resource mouse pad. If you go to axontiretips.com, go to the bottom, fill out the forms, and put your information in there. They'll send you not one but two resource mouse pads for all your resources needs that you may possibly need. So check that out. That axontiretips.com also has some really good white papers and some really good studies there that you can look at about having to do with compaction and a few other things there. So check that out. A lot of good information there. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. Valley Transportation, our goal is to help you reach yours. And no matter how you buy ag equipment, whether it's from a dealer, an auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. Lastly, Tractor Zoom has access to over $20 billion worth of heavy machinery sales data. Tractor Zoom's Iron Comps is the industry's trusted solution for transparent heavy equipment values and auctionable pricing insights. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's happening in the marketplace. Shawn, how you doing this morning?
I am doing very well. Never better. Back from Montreal.
Made her back from French Canada all the way down there. Was the weather nice up there?
50s at night, 70s during the day. If you're not a Floridian, you would think it would be great. I was chilly.
I bet you were. You probably had stocking cap on, gloves, the whole 9 yards.
Yeah, needed a little those charcoal activated gloves,
Yeah. I bet you did. On the verge of frostbite up there, being temperatures like that. All right, Shawn. There's a lot of turmoil right now in the marketplace. Tons of sell-off over the last couple of weeks. Corn and soybeans have lost almost $2. You look at cotton. I want to talk about that a little bit here. Cotton right now is trading at $1.09, and that was this last week when we talked about it. It was $1.40 something. So huge decline in cotton. I guess as you're looking at the cotton market right now, Shawn, it's one of those leading indicators about the economy and all those other things as well. But everything over the last couple of weeks have just taken a haircut. So I guess talk about that a little bit. We see happening there.
Well, it's interesting because remember, normally commodities go up when the dollar goes down,
right?
Throughout history, but the last 2 years the dollar's been going up and commodities have been going up. Very unusual to see both going up at the same time. But the U.S. dollar was devaluing against Bitcoin, cryptocurrencies, meaning Bitcoin.
Mm-hmm.
So there was a devaluation going on, just not the traditional devaluation that we normally expect. Meaning against other currencies. Gold and silver were not devaluing. So, but then all of a sudden, about a month ago, Bitcoin completely crashed. The cryptocurrencies completely crashed.
Yes, it did.
And then the US dollar index started to surge further. And that finally got the speculators into feeling that now we actually have a stronger dollar. I mean, it's appreciating now against everything, including the cryptocurrencies. And we had a mass liquidation event on top of the Fed Reserve raising rates, lowering liquidity, and of course the worries over a slowing economy. And so we had copper getting hit, crude oil getting hit, everything getting hit. So I really think the trigger here was that once the cryptocurrencies caved in, then the market started to fear deflation. Because whenever the dollar rises against everything else, it's a deflationary force. And once they start selling, Casey, the margin clerks get control. They force selling, more margin calls, force selling. And then all of a sudden, everyone starts believing the narrative that, we're going down the tubes and then the technical barriers are broken. And then you have just a complete crash. And that's what we've had. But as you know, Casey, we've been warning on the show. And, remember, we were super bearish in May and warned about a major important top in grains in late May, which is exactly when it happened. But we've been warning about the really strong potential for a weather scare rally from now into the latter part of July, late July. I think that weather rally actually started. So it's just started now. The overnight trade were up big. and we're starting to see the forecast for the U.S. after this week dry out considerably with some heat coming back in. But more importantly, Europe is burning up. I mean, it looks like we're going to have 100 degrees, 105 degrees, no rainfall for the majority of Europe, for the next 2 to 3 weeks. And we warned that both Europe and the U.S. would the combination of those two would set off a weather scare rally that producers could sell into. And I really think that Europe is the bigger story here right now. I mean, it looks really, really rough over there. And of course, it's really, really a story for wheat. That's really what they are going to have a hard time getting through here. And so if you're a producer, and you haven't sold everything you wanted to sell, or you missed the May high or whatever that case, I think you're going to get a, 2 to 3 week rally here. Doesn't mean we're going back to where we were, by the way, but a nice rebound weather scare rally that you can sell into and get some better prices. If you're in the livestock business and you need some short-term needs, you're not covered in let's say the next 30 days or 60 days, you might want to get some feed bought on a short-term basis because we never know how far weather rallies will go, but I'm pretty confident this combination of really, really hot, dry Europe and drying and warming up US is gonna allow for some reversion of this big correction we've had. So
right on. Okay. All right. Just talk about milk here for a second, because again, milk was not sheltered from any of this last couple of weeks of this storm that we saw on the 29th of June. It was trading at 24.33, and today it's at 22.39. So you lost almost $2 a gallon not $2 a gallon, $2 per hundredweight out there. And I guess as you're looking at milk right now, I mean, what are you seeing right there, and what are some of the tells you're seeing there as far as milk price goes?
Well, we have been warning our dairy producers that we thought we'd get a big break into that 21, 22 area. We made that forecast in May and reiterated it in June. And so this is exactly, and it was really predicated on the idea that a lockdown China would have to pull back from dairy demand. Without China buying dairy, international prices would tank, which they have, and the U.S. price always follows, which it now has. So that's so just as an example, their dairy demand in the month of May was down 16% year over year. Shows you how much their demand pulled back because of the lockdowns and that sort of thing. But now that that's happened, the next iteration of this is that they're starting to slowly lower these restrictions on these 500 million people that they've told to stay in their homes and apartments and don't go anywhere. They're starting to ease restrictions. We just saw yesterday and today some serious monetary and fiscal stimulus that they're now going to be pumping into the Chinese economy. Think what we did in 2020. It looks like they're about to do that now to get their economy going again and repair some of the damage that we know occurs when you shut down huge parts of your population for 3 or 4 months. So I think that huge stimulus and the gradual lowering of restrictions is suggesting that as we get into the fall, their demand for dairy and for meat proteins, by the way, whether it's beef or it's pork, chicken, we're going to see a big surge, a resurgence of that demand to feed into this reopening and fiscal stimulus, and to do some restocking, which of course, they've been running down some of these supplies. So I'm pretty confident that the correction in milk is probably mainly run its course. It doesn't mean it off and away to a bull market right away. We might need to do some bottoming action here, but I kind of think most of the downside is behind in dairy. And I think from here, I'm looking at a bottoming out and a surge to new highs as we get into the fourth quarter. So I like what I'm seeing from China. And by the way, this would have bullish implications for things like cotton and things like copper as well. Things that are economically sensitive to the Chinese economy and the Chinese demand, like dairy, like beef, like cotton, like copper, I think are going to have a renaissance, from late summer into the fourth quarter. In most of those markets, if you look at the charts, have reached some pretty serious support that probably bottoms them out. So I think for the most part, Casey, the worst is behind us on dairy.
Okay. So I was reading an article that's funny you bring that up. I was reading an article this morning about in Shanghai, they're back on a COVID alert, and they're toying with the idea of completely shutting everything back down in Shanghai again because of another outbreak. So something to pay attention to, something to watch, because just like you said, if that comes back into play, then that you're still looking at getting supplies over there, because they've got to be to the point now where, like you just talked about, supply has got to be low, and they've got to start feeding that funnel back in there. So
yeah, it's going to be a slow moving train. There's going to be stops and starts. They're going to reopen and reclose. But overall, I think by the time we get to the fall, and certainly by the time we get to the fourth quarter, I think they're going to be a pretty decent swath of that group are going to be in some kind of a reopening phase. And that's why I don't think it's a V bottom here. I think we could bottom out, have a bottoming pattern here while we slowly get this going. But the fact that they're willing to pump serious capital into the Chinese economy through money printing and through fiscal stimulus, I don't think they would do it if they were going to remain locked down. I think they're doing it because I think they're getting ready to remove some of the restrictions, and they're trying to provide a tailwind to those people that are obviously going to be hurting from their businesses, not having any revenue and people not being able to earn income and that sort of thing. So it's complicated, but I do think most of the downside is priced in here. And I do think at some point, even if you're locked down, you still have to eat.
Right. Yeah. Well, so much. That's another good point you make there, because another article I read this morning, they're talking about the Chinese pork price and how it surged so much. And most of it's around the fact of the reluctance to sell by producers, because they need to keep what they've got so they can feed their families or whatever that they've got going on around them. So talk about what you see. How's that affecting what you see in the overall, the hog market right now?
Well, we've talked about this lots and lots of times. We had that second round of African swine fever about a year ago. It forced herd liquidation, massive oversupply. It crashed the pork price. It crashed the hog price in China, and our exports to China just evaporated. Mm-hmm. Without selling to China, we have too much pork. Even though our animal feeding units in the U.S. are at 5-year lows, we still need to sell to China. We can't sell enough to everybody else to not have an oversupply. But now we're starting to see the hog price in China take off, as you said. We're starting to see that this oversupply has been worked through, and now we're going to be in a herd rebuilding phase again over there. And that means that the available supply of hogs that are going to be available to the market as we start reopening, as they're pumping money into the Chinese economy, is not going to be enough. And so they're going to have to come back and buy from who has that supply. And obviously the U.S. is one of the few places that has large quantities of pork that they can buy. And so I do think that the outlook for pork demand and pork exports to China from the U.S. looks very, very good once again from the third quarter, especially into the fourth quarter. So I think the hog market, I would be pretty constructive of the hog market after this correction we've seen. I think we're going to be looking at a pretty good go of it as we get into the end of the year. I think all the meat proteins are looking good, including dairy. And like I said, anything that's economically sensitive to Chinese demand, including soybeans, by the way, soybeans obviously, catch a bid too. If they've got to start feeding a bunch of piglets and they start producing more animals, they're going to need a lot more bean meal. And that means that they need a lot more soybeans to crush into bean meal. So that's something you look out on the horizon on soybeans and there could be a surge in demand in soybean exports as well later in the year. So all this is suggesting this vertigo, this crash we've seen on some of the factors we've talked about, I think is temporary. It may last a little while longer, but I think by the time we get past August, Casey, I think we're going to be looking at some pretty exciting upside again. And so those on the cash buy side of these markets need to be very careful not to let these lower prices, go away. I really think you have to have some kind of a program, a buy program for your feed needs, for the buy side of these markets going into the end of August, to make sure that you're methodical and disciplined to getting the job done. Because once this thing turns, I don't think you want to be, chasing $8 corn again. I think you've been given an opportunity to get yourself in a better spot cost-wise, and you should definitely be, looking to do that between now and the end of August, early September.
Okay. All right. Let's talk about India for just a minute here. So they banned wheat exports in May, and they've kind of opened that back up a little bit, but not hardly like at all like it was. But for the most part, it's still pretty well locked down. Now they've banned, at least they're requiring permission to export wheat flour out of India. As you take a look at what's going on right now with wheat harvest, and it's not been a good crop at all. I mean, it's very spotty, but for the most part, it's just not the best wheat crop we've had in a long time. So I guess with that news coming out of India now, where they're shutting down flour and wheat exports altogether, so everything, and then what we have now, what are your thoughts on wheat, and where do you see it headed here over the next couple months?
Well, I mean, wheat has lost $6 a bushel.
Right. Yep.
So it's quite a haircut.
Yes, it is.
It's quite a haircut. So why has it fallen $6 a bushel? I think it fell $6 a bushel because a lot of the speculators that piled into wheat piled in because of the Ukraine-Russia story,
right,
and the inflation story. And when the dollar started to take off and Bitcoin started to crash and the Fed started to raise rates, they started losing the inflation story. And all this, and they just, you can only trade a story for so long, Casey. I don't care if it's weather, I don't care if it's a geopolitical event, but the market no longer cares about Ukraine, Russia in terms of the market pricing mechanism. They've lost interest. It no longer matters to them. I'm not saying it doesn't matter, but to the market, it's moved on. It's not interested in trading Ukraine, Russia anymore, unless there's something new and exciting that comes out that's a different iteration than they're at war and it's nothing's changed. They're talking, but the market's done with that. They don't want to trade that anymore. And we saw the same thing with the trade war. After a while, the market just didn't care anymore. Yep. It just didn't matter. They moved on. So all those people say, well, why do I own wheat if I don't care about this Ukraine situation anymore and the inflation story is over? And then they sold off. But the fundamentals have not changed at all. So here's a situation where the fundamentals don't really change much, but the price can change dramatically based upon the perception of speculator psychology. There may not be a ton of supply in the physical market, Casey, but there was a ton of supply in the futures market. That's a fundamental. The futures speculative supply that can be sold onto the market at once, if those speculators want to, is a fundamental in the market. Now, it's a financial fundamental, but it is still a fundamental. And I think a lot of people in the market who analyze markets don't correctly factor in the supply of speculator supply potential in the market. They only look at supply, physical supply, and physical demand. There's nothing wrong with doing that, but we got caught with too much speculative supply coming onto the wheat futures market and not enough buyers, and the market has done what it's done. Having said all of that, certainly you start getting into the $7 to $8 area, Casey. This is a good value again. We're getting to a place where the market is overshot. The fundamentals haven't changed too much. Ukraine still isn't looking like they're going to be having record crops and being able to export stuff anytime soon. And even though Russia and the U.S. is harvesting and we have that typical harvest pressure, the situation in wheat is still very precarious. And so I think now that it appears to me that the speculator are getting sold out of wheat, meaning that they've done most of the selling that I think they need to do, we now can get back into a constructive period where I think the wheat market can reprice back up again and reconnect with what's actually the correct fundamental price. I don't think 7.5 or 8 is the right fundamental price to the downside. And I don't think 14 was, I think 14 was too high. There's some number in between, Casey, that's the right price for the current situation. And my job is to look at when we overshoot in either direction and make sure producers and end users take advantage of that when it's to their advantage. Right now, a physical buyer of wheat, needs to be looking at procuring those physical supplies during this week period, because I don't believe this is sustainable. We might be able to sit here for 30 or 60 days, but I don't think this is a sustainable level going forward with what I see coming. And remember, we're just beginning in the midst of what's clearly going to be, in my opinion, a major weather market here in Europe on wheat. So already prices may be ready to do something to the upside. So I really, really want to emphasize physical buyers of wheat. Doesn't mean you buy it all, but you just need to get some upside protection here or get some physical needs bought. You've got a $6 haircut. Sure, it can always go lower, but how much of a haircut do you want before you start putting some physical wheat in your coffers at a huge discount from what you were looking at just a couple of months ago? It's time to be looking at the buy side of wheat as a physical buyer.
Right on. All right, good stuff as usual, Shawn. Folks want to reach out to you and get more information about what it is you're doing at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. Lots of information, white papers, podcasts, interviews, sample reports to give your listeners a really good idea of how we do things with our weather algorithm, our capital flows algorithm, and some of this fundamental work to see if we could be of value and of service to your listeners.
Right on. Okay. Shawn, appreciate you being on the podcast, man.
Thanks, Casey. Always a blast.
Thank you very much. All right, Shawn Hackett. I am Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. You can also go to Moving Iron on LinkedIn at Moving Iron Podcast. You can also check us out on the YouTube channel at Moving Iron Podcast YouTube channel. So check that out there as well. Looking for more information about the Moving Iron Podcast, go to MovingIronLLC.com. Everything Moving Iron related is there. Blog posts, all the entire library of the podcast, as well as all the information for the Moving Iron Summit coming up here in Nashville, Tennessee, September 6th, 7th, and 8th. If you're interested in checking that out, if you're a dealer, you want to check that out, go to the upper right corner, click on the Moving Iron Summit tab, and all the information is right there. If you need more information, send me an email at MovingIronPodcast, MovingIronPodcast.com, and I'll be happy to get that information back to you. So my friend Alex is still over in Ukraine, driving around, passing out humanitarian aid. So if you're interested in helping Alex, go to his GoFundMe page and look up Help Alex Transport Humanitarian Aid from Poland to Ukraine, or just go to the show notes here and you can click the link there and help him any way you can. So with that, I'm Casey Seymour with Shawn Hackett. Let's go to Smart Folks. Out.
Moving iron in the 21st century. Hard work.